So here's another tip to help you understand the markets and trade them like a professional, or maybe put differently, not to trade them like a total idiot. I call it the 40-30-30 rule. I was talking about the rule of 10 last week. This is the rule of 40-30-30. Okay, and it's really just a matrix in order to understand why stock prices move around. I mean, some of the people I talk to have got no idea. Obviously, they prefer the share prices that go up to the ones that go down. When you see a stock moving, so let's say that over a period of a year, a particular share doubles in value, I want you to be asking why it is that something should do that. And the 40-30-30 works as follows. 40% of the value of a stock or the movement of a stock in the market is a function of the overall level of the market. In other words, if the global markets are strong, then everything is going to be moving along in terms of that broader direction. If the market, on the other hand, is looking very soft, there's a global recession on the go, everybody is going to get washed down. As they say, it's the tide that comes in and out of the harbor, and the boats all get lifted or dropped at the same time. So the market is setting the base price of each and every particular stock. The next thing is the sector that the stock falls in. So for example, a share is in the communications sector, or it's in the resources environment, or it's a bank, or it's a retailer. Clearly, those sectors have different dynamics. Retailers might be responding to a hike in interest rates, or they might be going down the drain because there's a deterioration in consumer confidence. In that environment, everybody is going to get the drop. Conversely, if commodity prices are strong, then everybody across that particular spectrum is going to be getting the benefit of a lift. The final 30% is due to the stock itself. Okay, so we know that in a particular sector of the economy, there are big successful companies, and then there are small ones that are not so successful. There are small companies that are gathering market share and making great progress. Those would be the sector leaders. On the other hand, you might find that there is a particular player in the space which is doing particularly badly as a company as a result of some problem with assets they've got, or a disposal, or a firing of a management team. Then clearly they're not going to be doing very well. So you can see there are a couple of examples here. I've got a situation where a stock is doing very well. I need to understand why that's happening. Makes sense to look at the sector, because clearly if a stock is doing well relative to its peers, it's another indication that the market is falling in love with it. It's got some momentum and that it's moving forward. Conversely, you might find that there's a stock which is doing very well in terms of its own business, no problems, but the overall market is down, and the sector that it falls into is doing particularly poorly. So for example, a stock like Wilson Bailey recently, doing well, company results haven't been too bad, but because the construction sector is being dragged down and the sector leaders like Murray and Roberts are doing very poorly, the overall sector, the whole thing comes down in a wash. And consequently, one can draw different conclusions from that particular thing. So remember, 40-30-30, be looking for the right reasons why stock prices change in the market.